that the sectors and industries that Daniel and I are talking about were failing because of mismanagement and general poor strategy, that they need more money. It is because oftentimes what starts off these types of crises is that exogenous shocks to these types of essential industries impacts them disproportionately than everything else. It is in most cases that, for example, banks started over-leveraging themselves into the housing market, started developing some of the most predatory loan systems imaginable to the American public, and then as a result, when a lot of people lost their mortgage, lost their ability to have a job, it then meant that hospitals that were reliant on the strength of the overall economy lost their ability to pay their workers. So, it isn't the case that on opposition side of the house, the problem with investing in the firms that Daniel and I want to is that they are failing. It is in fact on their side of the house where you are propping up zombie industries that either are failing because of corrupt mismanagement, that because they have already proven too large an appetite to implement risk and have not yet changed at the top in any significant way, and it isn't the case that you're going to see a fundamental shift in the type of investment strategies that banks are going to do and start investing more domestically into their economy. The reason being is exactly what Daniel points out, that these firms have already over-leveraged themselves. They have invested entirely too much. They want to recoup their losses, meaning that they take the money that the government gives them and does nothing with it because they need to shore up their capital reserves and make sure that they are able to be stable into the future. The second most likely thing that they're going to do, again, isn't to invest into the economy. It is to pay dividends to their shareholders because when there's a crisis, those very shareholders are frustrated at the fact that they haven't been able to make money recently, which means that they're going to pull money out of the banks rather than expect it to be invested in a situation where already it is highly, highly difficult to be able to make a return. Why is it that Daniel's extension wins this debate outright? The first reason is because we are the team that is able to explain why these firms in particular need the money and will use it well. The reason they're going to use it well is because it's not that we are going to start building a road that nobody has planned for, that nobody knew where it was going to go. It is that the road already got zoned appropriately, there's already been research into it, shovels have likely already hit the ground, but then the economy goes into a crisis and they need more money. What does that mean? It means that job openings happen tomorrow under our side of the house because they need to deploy this immediately. The reason being is because the longer these projects delay, the more money these companies lose. Because as Daniel says, these companies already took out loans to finance their projects, meaning that the longer and longer that they take to be able to actually open the new road or open the new hospital, the more interest they are paying back to their initial creditors, which means that they lose out on substantially more money than they otherwise would have had. Their interest is to start work immediately. This is what unlocks everything else. It isn't because what opening government said, which is that vaguely it is good to be able to make sure that these people keep their jobs. It is because it is the most rational profit incentive for these entities to start this right now. A few other pieces of responsiveness. So, on opposition bench, they have these sets of claims about how it is that our side is still able to get money. Opening opposition's version of this is that you can get FDI. Closing opposition's version of this is a claim that, well, once you invest in the right institutions, the money will circulate and eventually get back to you. The problem with this is multiple-fold. The first is that in a counterfactual, a lot of these institutions take on a lot more predatory loans, or at least loans with a lot worse of an interest rate, or that have worse requirements. And like, there's a lot of them. I'm not just making this up in the sense of like, oh, it'll be worse interest rates. In a lot of circumstances, what we've seen is things like in Chicago in the middle of the 2008 recession, the government of Saudi Arabia bought all of the parking meters in the entire city and has required that they offshore every single dollar for the next century that is made off of parking. The reason why these institutions are going to do ridiculous stuff like this is because if they're not able to fund their most basic, bare bones operations, either in the worst circumstances like with hospitals, people die, or in the less extreme circumstances like with construction projects, it means that they have to lay off their staff and they lose such substantial trust with the government that they become unlikely to win government projects in the future, meaning that they don't see an incentive to do anything but take on these high-risk, high-leverage loans. Yes?
So if this is a flourishing market with a variety of companies, some of them going under is fine, so long as it doesn't crack down with the rest of the economy, which employs more people and provides more services than a couple of particular companies.
So here's the thing, right? I get what your argument is, which is that you shouldn't support the entire sector. You should only support a few companies that are doing this well. But Daniel's analysis is that structurally, all of these companies are doing mostly pretty well, and mostly aren't going under. So, thanks, but you have to then prove that a lot of these companies were doing poorly. And your best version of this was that these companies are investing entirely too much in research and development. No, they're not, right? They don't need that much research and development in order to make that much money. What they end up needing is labor and people using their resources, because they often get paid by the usage, meaning that their incentive is to be open as long as possible, as much as possible. They're not often trying to entirely reinvent the wheel, right? R&D is often a capital sink for these firms. They're often trying to make sure that they can have the most operational staff as possible. So, a few other things. Opposition bench wants to say that, well, under our side of the house, the problem is that, well, there's not as many other options that exist to be able to make sure that the economy as a whole is able to do well. This also isn't true, right? All we have to do in this debate is say that when the central banks are choosing how to deploy cash directly into the market, that this is what they should do. But simultaneously, they could do things like reduce the amount of interest that they have for other loans that they are issuing, and they could do other things that exist within monetary policy in addition to these types of policies. The reason why this is particularly important is because it fixes a lot of the issues that the opposition bench has, right? If their claim is that firms should be able to get access to more money, we're the team that's actually able to establish that these firms can get other money in other ways. They had a burden to say that this specific mechanism had a very hard way of making sure that they weren't able to access money, but they weren't able to do that without just saying that these firms were prima facie bad, but that's not actually true. Lastly, what we're able to establish is that outright, we are able to get better business conditions for the future. It isn't just because of what opening government said, which is that more people get employed, but because when we're able to develop more infrastructure, it means that the ability for people to conduct business in the future gets lower, because it means that there was more infrastructure in the first place. More roads means that there's more usable land for people to open up businesses, so it's easier to have lower rent. It means that when there's more hospitals and those are growing, it means that every area nearby it becomes more valuable for businesses to start up in, where previously they were not necessarily sure if they wanted to be able to do so. I'm very proud to prepare this.